There's a new trend appearing in the property space. Savvy and experienced investors are moving from your standard residential properties to mixed-use commercial assets. Now, these type of properties combine both a commercial element and residential element all on one title. For example, you might find a shop, an office, a pub, a restaurant, a cafe, even a nightclub downstairs, and a series of flats above. Now, it's this long-term cash flow generated via commercial tenants who sign long leases, coupled with short-term cash flow from private tenants that rent the flats above, that are attracting more and more savvy investors into the space. But the questions are, what are the eligibility requirements? How much money does it cost to buy a semi-commercial mixed-use property asset? And what are your chances of obtaining a mortgage? If you're new to my channel, hi, I'm Jonathan. I founded SPV Mortgages around 6 years ago. We're a specialist finance brokerage. We've helped hundreds of property investors start and build their property portfolios over the years. My channel is all about the experiences I have with them, sharing with you. So let's start with eligibility requirements. Now, to get access to 100% of lenders operating in the mixed-use semi-commercial space, you need to be an experienced landlord for at least 12 months. So that's not necessarily that you need to have managed the property for 12 months, you just need to have owned a property that has been let for 12 months. That will give you access to the widest range of semi-commercial, mixed-use commercial lenders, which is important because some lenders will lend on certain buildings and other lenders lend on others. For example, some lenders won't lend on pubs, nightclubs, anything which is related to chemical use, such as laundrettes and hairdressers. But the good news is the majority of lenders are quite flexible with the type of property that they do lend on. But what if you don't own any investment properties at all, and you don't want to buy a residential property, such like a house or a flat, in order to get access to a mixed-use semi-commercial mortgage? So the good news is there are lenders out there that will lend to not only first-time landlords, but also first-time buyers. In order to provide comfort to the lender as a result of you being a first-time buyer, first-time landlord, you need to have a really strong background. And what I mean by that is you need a good level of income, a healthy cash reserve, be happy to put down a larger deposit, and have a very strong reason why you want to invest in mixed-use commercial assets. And I'll give you a quick example. We had a client last year who was a doctor, and he is a first-time buyer, first-time landlord. He's moving into a practice, and he does have the opportunity to purchase this practice. Above the practice is a block of flats. We approached the lender, we explained that, look, he is a first-time buyer, first-time landlord. He was earning around 120 grand, had circa £500,000 in cash in savings, and the lender was absolutely fine because it made sense. He's a business owner looking to purchase business premises that he will rent from himself and obviously generate an additional set of income from the flats rented above. Deposit requirements are around 25% plus. You can purchase the property in your personal name, an LLP, a trust, or the most popular ownership structure right now, which is an SPV limited company. Ideally, you want to be a UK national with a clean credit footprint. So how much money do you need to actually buy a mixed-use commercial asset? So I'm going to break this section down into three parts: stamp duty, deposit requirements, and then acquisition costs. So if we start with stamp duty, as a result of the mixed-use commercial asset having a commercial element, the stamp duty is actually around a fourth of what you would pay for a standard residential property, making the acquisition cost significantly lower for a mixed-use commercial asset in comparison to a house or flat. Deposit funds. So this is where new semi-commercial mixed-use investors get a little bit confused. When the surveyor goes out to the property, they're going to value the property using two metrics. One is open market value, which is the value of the property in its current state. Ideally, it should have a commercial tenant, and the commercial tenancy is taken into account when valuing the property. Let's say, for argument's sake, the building that you're looking at is worth 1.1 million. Now, they also provide what's known as vacant possession, which is the building without a commercial tenant. Let's call that £1 million. Now, with some lenders, they will lend up to 75% of vacant possession, which will be, in this case, £750,000, 75% of £1 million. But the purchase price is 1.1, meaning that although they're lending 75%, they're not lending 75% of open market value. So you need to be very, very careful with the lender that you choose using forward to ensure that you have enough money in the bank account to cover any difference between vacant possession and open market value if the lender is basing the valuation on that side of things. There are a number of lenders that will lend on off open market value, and that's typically how we run the transactions this end. In regards to legal and valuation fees, you should expect and assume to pay more than your standard residential purchase. And the reason being is there's a lot more work to take into account when checking the tenancy agreements, especially on the commercial side, and there are multiple units within the building. Typically, legal fees can be double that of residential. But when it comes to valuation fees, and this is really important, typically, when you purchase a house or a flat via an SPV limited company, which the majority of investors are doing these days, you will pay for what's known as a short form valuation. It's basically a couple of pages of information. It's a risk assessment for the lender. It deems if the property is suitable security for the loan, but that's about it. With semi-commercial loans, it's a long form valuation. So it's pages and pages and pages of information detailing as much as a surveyor can detail about the property, so that the lender has peace of mind knowing that in the event of repossession, they will definitely be able to sell the property. With long form valuations, they run into the thousands of pounds. So when you do find a suitable property that you think ticks all the boxes and you're happy to move forwards with, just keep in mind that you will be subject to quite large valuation fees at the start of the process. So just make sure you're committed to obviously purchasing before engaging. As you would expect with mortgages, they're very similar to SPV limited company buy-to-let mortgages in that there are 2-year deals and 5-year deals, and there are some variables as well. The variables at the time of shooting this video, the margin between the fixed rate and the variable is pretty punchy, so we haven't been transacting any variable mixed-use semi-commercial applications for quite some time. But typically with a 2 or 5 year deal, as long as the rental stress test meets the requirements for those products, then the lenders are more than happy to lend. Regarding rental stress tests, most lenders apply 125% at pay rate if it's a 5-year deal, and 125% at pay rate plus 2% if it's a 2-year deal, meaning that as long as the rental income is sufficient to meet a stricter stress test requirement on a 2-year product, then 2 years fixed will be available for you. You should expect to pay around 2% as a product fee. That's pretty standard across the board. Some fees run into the 5s and 6s, so it really depends on the rental income in comparison to the stress test as to which product to move forwards with. Loan to values range from 70% to 75% depending on the lender. Some lenders lend 70% of open market value, other lenders lend 75% of vacant possession. So just keep in mind, it really depends on the underlying policy at the lender as to how they're going to actually assess that loan to value. Now, when it comes to product selection, it's really important to take into account the cost of refinancing. Now, there are no freebies in the semi-commercial mixed-use space, and more than likely there never will be, simply because the market is a lot smaller than the residential market or even the buy-to-let limited company market. So when you're looking at 2 years versus 5 years, what you've got to do is factor in any interest rate drop, the saving in interest versus the cost of refinancing. Now remember, we touched on the cost of long form valuations. They run into the thousands of pounds, and legal services and product fees. So even if you think that the base rate might drop, say 1.5% or 2%, take that saving and then calculate the saving versus the cost of refinancing, and then obviously make an educated decision as to which product would be more sensible, taking into account those upfront costs within 2 years. I receive a huge amount of calls about bridging finance and my brokerage SPV mortgages, and some of the questions that arise from clients looking to do property projects are pretty common. So what I decided to do was to shoot 2 videos. This one's for beginners and this one's more advanced.